Man, this stock market, it is plummeting right now. It is starting to correct quite a bit. There's a lot of panic out there, a lot of fear out there. The coronavirus is really causing some incredible fears in the global markets right now. And as a seasoned investor with well over 20 years experience, I want to bring some calmness to the discussion. And I want to share today four critical lessons that all investors out there, dividend investors or not, although these lessons are more catered towards dividend investors because that's what I am. I'm going to share 4 lessons today that I think everyone needs to know. Everyone needs to know these lessons right now to prepare for what's happening right now and what could be happening right around the corner. So I'm going to talk about those 4 lessons today. Also, I actually happened to purchase 2 stocks today. I purchased more shares of 3M Company. I'm going to discuss that. And I purchased more shares of Cedar Fair, ticker symbol FUN. This is an amusement park company that reported really good earnings just now, but there's a lot of fear with the amusement parks right now, cruise ships, similar industries because of the coronavirus. So Cedar Fair is plummeting despite their really good earnings. I bought some more shares. I'm going to talk about that today. I'm going to talk about a whole bunch of other holdings of mine as well, though, because these discussions, they're going to illustrate and help embellish on some of the lessons that I'm sharing today. So get ready, everyone, and don't worry. No need to panic out there, in my very humble opinion, at least. Let's talk about investing. All right, everyone. So I'm going to talk about the 4 lessons. Before I even jump into that, just a general disclaimer that I do not provide investment advice. I'm just sharing my personal journey here on YouTube for fun and entertainment. And it's important to remind oneself in the community of this. During times like this, when there's a lot of volatility, it's possible to lose a lot of money in the stock market. And so again, I'm just sharing my personal journey, and please do go seek professional advice, investment advice from a licensed advisor before making any financial decisions out there on your behalf or your family's behalf. But anyways, I do want to share my journey today. So personal journey, I'm going to jump into lesson number 1. And lesson number 1 is I see too many people out there right now getting so excited about these buying opportunities. They're jumping in. They're going all in with these buying opportunities right now. But quite frankly, all I see so far is buying opportunities in the more marginal stocks, the more risky stocks, the more junky stocks, if you will. Now, I own 44 stocks in my personal dividend stock portfolio, but I'm not going to lie, a holding like Royal Dutch Shell, that's more of a junky position than a holding like Coca-Cola, for example. And we're going to talk more about that later. But what I'm seeing is the premium stocks, the really quality stocks, those foundational stocks that are so important to create a core, a foundation for the portfolio. Those stocks, they're not really correcting yet. And I'm going to share on the screen lesson number 1, takeaway number 1. This one has a ton of text, so listen to me as well. But if you like to read ahead, please feel free. But you'll see there right at the top of this that Coca-Cola, they just hit an all-time high of $60.13. Intraday today, when I was preparing for this video, is trading at $57.77. So this one is only down 4% from the high. Again, I want to remind people that there is not really a panic selling situation yet. There is not really some mass opportunity like there was during the Great Recession. We're starting to see markets correct, but I'm seeing it more pronounced, quite frankly, with the riskier stocks, the junkier stocks. Again, I don't want to insult a very holding of mine, but Royal Dutch Shell is a good example. Royal Dutch Shell is down 30% from the recent high, and I'm seeing this with cruise ship companies, amusement park companies, other energy companies. There are certain sectors that are getting hit really hard right now, and the problem is most of these sectors that are getting really hit hard, they're not the premium quality stocks. And so for me, it's really, this is really important. I do a lot of videos here on YouTube. I discuss a lot of different things. Sometimes what I think gets lost is the fact that I have a really, really strong core, and I don't talk about it that much because it's been built over the course of 20 years. For example, how much of my money do I have right now in Johnson & Johnson? Johnson & Johnson is 7.8% of my total portfolio in terms of dollar value approximately. By contrast, Wells Fargo, I'll tell you, I got a tweet the other day. I bought some Wells Fargo, and then one of the subscribers was tweeting me, "Hey, Ian, I told you it was going lower. You should have waited." Here's my response. Wells Fargo right now is 0.33% of my portfolio. Even though I bought a bunch of tranches and I'm building it up, when I'm done building it, maybe it'll be 0.7, 0.8% of my portfolio, maybe 0.65, somewhere in that range. There is a difference. I talk about Wells Fargo a lot because that's what I'm going through now and that's what I'm buying now. I don't talk about Johnson & Johnson as much, but there is a vast difference between having 7.8% of my money in something and 0.33% of my money in something. And so first and foremost, that context needs to be presented here under the lens of lesson one, because yeah, I am going out in the stock market now and I am buying some riskier companies. They're still premium quality. I only own companies that I want to buy and hold forever. But within my 44 stocks, I have stocks that are core, stocks that are kind of medium, stocks that are ancillary. Wells Fargo, it will always be an ancillary holding of mine. It will always be kind of a bottom of the portfolio holding. And it's a great company, in my personal opinion, facing hard times, going through a turnaround. I think there are brighter days ahead. I'm pretty certain of it. I like the fundamental analysis and the metrics. And so for me, buying Wells Fargo right now, yeah, I'm down a little bit on capital appreciation, but the way I buy is I dollar cost average in over time. And with each progressive tranche that I buy, I like that it's going down because I can get more cash flow for my money. But it's so important, again, to paint this picture that the quality stuff, the Johnson & Johnsons of the world, the Coca-Colas of the world, they are not in free fall tanking category yet, like something like a Royal Dutch Shell or a Wells Fargo. And quite frankly, those aren't in free fall yet either. They have a lot more to go down. And so I want to talk about this just to hammer home this point. The biggest risk here for stock market investors, especially because a lot of folks watching my channel are newer to investing, is building a portfolio of junk. Literally, all the stuff in free fall now is, I wouldn't say junk. Again, I don't want to put down the very companies that I own, but it certainly is not the Coca-Colas of the world, the PepsiCos of the world, for example. And so the biggest risk that when you are at home and you're thinking about, hey, the market's tanking, there's some opportunities out there, the lesson, the takeaway that I would say is just be awfully careful about your overall allocation and think, which of all the positions you're going to add to your portfolio, what's the weighting you want for each? I'm really clear with myself. I don't want more than 1% in Wells Fargo. I want around 8% in Johnson & Johnson. Certainly, I wouldn't feel good if that were flipped around. I would feel really bad. And sometimes it helps clarify strategy in this kind of situation. It really, really does. I want to talk about Home Depot as well, for example. Home Depot is a really high quality company. I'm going to talk about this in a minute. They just raised the dividend. My yield on cost is really substantial right now. And that's 1.8% of my portfolio. So again, there's a big difference, or 1.9%. There's a big difference between having something that's 1.9% of the portfolio and something that's more ancillary at a 0.3%. Now, the watch list. I'm obviously going up to bat right now. I'm buying stocks. I'm buying them because the market is tanking, especially in certain sectors. I have a lot on my watch list. I have energy companies on my watch list like BP and Royal Dutch Shell. I have Cedar Fair on my watch list, which I picked up today. And I have companies like 3M on the watch list, which I picked up today. It's more of a quality company. I have a company like Honeywell on my list right now, which is an ultra premium quality company that hasn't even started correcting very much. But I'm hoping that this situation progresses a bit further and there are more opportunities ahead for quality. And so for me, it's, even though my portfolio is already really skewed towards quality, like the J&J example, even now, I don't want to only deploy money in the riskier stuff, the lower quality stuff. I want to deploy some money at least in quality like Honeywell. And I feel 3M kind of gets me there as well. That's more of a quality company. And that brings me to my last point here. Outlet shopping. I don't know how many of you out there shop at the outlets, the premium outlets, the outlets. I do most of my shopping at the outlets these days, and there are two types of people that shop at the outlet stores. There's those people that spend the time to cherry pick the really good quality clothing, and so they leave the outlet looking like a boss. They leave the outlet looking like really good, looking like they bought that clothes at Neiman Marcus full price, but then you always see them. You see these people walking around the outlet and you're like, yeah, you look like you bought those clothes at the outlet because they look kind of, not so good. And so that's the stock market in a nutshell. Right now, there's stocks really tanking like a Royal Dutch Shell, and I don't want to insult them because I love them, but I got to be mindful. My allocation of Royal Dutch Shell, it will never be like a Johnson & Johnson or a Coca-Cola. There's kind of those types of stocks, and then there's the really premium quality stuff that you kind of cherry pick. And it's very rare, what I'm trying to say, very, very rare that the ultra high quality goes on sale. And so you have to be more mindful of an investor, even during a situation like this. I'm not seeing the ultra high quality on sale yet. And so I need to be like those outlet shoppers that spend a lot of time at the outlets and pick the one or two pieces that are really good versus those outlet shoppers that just go there with all these shopping carts and just dumping stuff in the shopping cart that's no good and just looks junky. And so that is lesson number one. Again, just be mindful. I don't think the quality is on sale just yet. And so I want to transition now into lesson number two, an important lesson that dividend investors, but just quite frankly, stock market investors should be aware of right now in the market that we're in. And that lesson is don't deploy the money too quickly. This is so important. I'm already getting a sense of this. I have a Facebook group of dividend investors. Love you all. And I see it on Twitter. I see it here on YouTube. People are getting really excited. Hey, I even got excited. I deployed a bit of money today in 3M and Cedar Fair, maybe a little bit more than I would have otherwise. The key thing, in my opinion, is we don't know what's ahead. We don't know if the market is going to fall more. We don't know if it's going to go up for here. And so for myself, at least, I always exercise prudent dollar cost management to the best of my ability. Surely, at the stage I'm at in my life, I just can't do it anymore. I can't borrow against future earnings. I can't borrow against my emergency fund. I did that kind of stuff in the past in my early days during the Great Recession era. It paid off very well, but where I'm at in my life right now, married, 2 kids, getting older, I just can't do that stuff anymore. And so at least a lesson for me is to be mindful, Ian, the stock market is going down. That being said, it's not like the ultra high quality is on sale yet. So there's no reason, absolutely no good reason to borrow against future earnings, borrow against emergency fund, create that kind of risk in my life for what? To buy more Royal Dutch Shell. It's going to be on sale for a while. And so I love you, Royal Dutch Shell. I'm telling you, I love you. But at the same time, I got to be careful. And so that's lesson number 2 that I think investors just have to be really mindful of in this type of stock market. So lesson number 3 right now is, personally, I wouldn't watch the market too closely here. What's funny is when this whole market correction started happening, I didn't even know about it. I was just on Twitter, and one of my subscribers, I love you guys, reached out to me and was like, hey, Ian, did you know the market's plummeting? What are you doing about it? It was then that I really realized, oh yeah, market's down a lot. And so for me these days, I rather just focus on living life. And I'll tell you, why do I invest in dividend stocks? I invest in dividend stocks so my money can work for me. My money is working while I'm sleeping, while I'm exercising, while I'm doing YouTube videos, while I'm eating lunch with my wife, going out on a date, whatever. And so the worst thing, in my opinion, is getting too caught up in the stock market because it becomes stressful. It, quite frankly, I think causes people to make poor decisions. It's when you take a step back. For me, I spend a lot of time on the stock market, but it's a bit different. It's not looking at charts. It's not looking at day-to-day activity or volatility. It's typically just reading financials, just reading and absorbing information, thinking strategically about the long term, about the next 20 years, 30 years, 40 years, 50 years, or more. And so, again, the takeaway here, the lesson is don't let the next few months of your life become all about the stock market. That's not, look, we all love investing here and we're a community, but the point of all of this, quite frankly, is so that we can live our best life. And our best life, honestly, it is not doing this. It is out there in the real world, nice sunny day, going for a run, sitting at the park, spending time with friends, family, all of that good stuff. So don't forget that. Lesson number 4 is we're buying streams of cash flow. And so as dividend investors, at least. And so for me, it was kind of a running joke. I know other people in this community have it. Sometimes I get lucky. Look, I buy the bottom sometimes. But today, I kind of knew, I'm buying 3M, I'm buying Cedar Fair. But you know what? As soon as I buy, the market's going to turn south even more than it already has. And lo and behold, that's what happened. And so you can thank me, everyone, for the lower prices after I bought. And I know a lot of people feel that way. And in a downward market, it is so hard to pick the bottom. And I don't even look at it that way. I actually like a stock market that keeps going down because each tranche of money I deploy, I get better and better yield, better leverage on my money, meaning my money works harder for me because dividend is yield is a function of stock price. Lower stock price, higher starting dividend yield. And so for me, literally, I just look at the cash flow. I'm just trying to build streams of cash flow that can pay my bills over time. Increasingly, I'm already paying some of my bills with dividends. And so I don't get too caught up. Oh, I bought it here and it's down. It's like the Wells Fargo example. 0.33% of my money, I bought it, say 5-10% higher than I had to. Whatever. I have so much more to buy. It just doesn't matter. I'd rather than specifically timing the market, just dollar cost average in and live my life. And so that's something I would say is even the best of us. I've been doing this a long time. I buy, it goes down right after. I buy, it goes right down. A few years from now, though, it'll all be trending, or at least 10, 20 years from now, I'm pretty sure I'll be happy with the prices I'm paying today in 2020. And so for you at home, if you're feeling like, hey, I buy and then it goes down and I feel upset about that, I would say that's how it is for everyone, quite frankly, in this type of market. And yes, some people will go out there on the internet and say, oh, I timed the market perfectly. But you know what? It's those same kind of people that it's kind of a reflection of life. They repeat all of their successes, but they don't share their failures at all. And for me, I'm just trying to share it all here. And any seasoned investor, when they buy, they're not going to time the bottom of the market perfectly. And so for me, because of that, and because I'm buying streams of cash flow, and because I need the cash flow right now, quite frankly, to pay bills, I just need to get my money going, progressively lower prices, and then use that stream of cash flow to pay bills. And so I love that about dividend investing. So I hope these 4 lessons were helpful. I hope they help calm a lot of people out there, because I see people getting a little worked up about what's going on now. And I also would say, quite frankly, is just to prepare for worse, because I wouldn't be surprised if the bottom does fall out of this and everything just gets cut in half. And so that's what investors need to be aware of as well, is that this is nothing. Like I said, premium stocks, they haven't even gone down at all. They're hitting new all-time highs. It's just certain sectors. And so, again, be ready for that as well. But look, if stocks plummet 50% from here, I will not be scared. I will not lose any sleep. I'll just keep buying the way I always do. I'll get to financial freedom quicker because of those buying opportunities. All right. And so with that being said, I want to move to the second part of today's video, and I want to just share some specific stocks. I want to share some of the stocks I just bought. I want to share other stocks that I own. I want to share these stocks to help illustrate to everyone some of the points that I just discussed and more points as well. Okay, and so the first one I'm going to share is going to be 3M Corporation. I'm going to share some stats on the screen right now. This is a stock I bought today. And I don't want to spend too much time here because I got to get through this video. I know a lot of you are looking for videos just to be a little more time efficient, although don't forget I have timestamps in the description below. But with 3M, I got it at $150.45. That gives me a 3.91% starting dividend yield. Not bad for 3M, world-class company. based on the analyst expectations for 2020, it gives me a PE just under 16, a forward PE. It's rare to get a world-class company like 3M at a PE less than 16, and so I felt pretty good about buying at these prices. Payout ratio is reasonable. Dividend growth rate is reasonable. This, I would say, out of everything right now that's on sale, perhaps this is like you're at the outlets and you're cherry picking that one or two items that are really actually good. And I would say 3M, it's one of the best quality companies around there, and it's at reasonable prices, not deep discount yet, but reasonable. And so I'd say of everything on sale, perhaps this is that marriage of sale price and quality that is so rare. And so I'm happy about that. I'll tell you my biggest takeaway from 3M, quite frankly, is I posted my trade on Twitter. I always do. Check me out on Twitter, or most of them I post. And I made a bunch of typos. I made 2 typos, major typos in my tweet. And then I responded to the tweet with the corrections. And what it told me is, Ian, you're moving a mile a minute. Your life is busy. It was a reminder almost to me that, boy, I just got to deploy more money, prudently at least. Of course, not borrow against emergency fund. I need my money working for me because I need to buy my time back, because I'm kind of in a mind state now where I can't keep up with everything. There's too much going on. And so isn't that the beauty of dividend investing? Isn't that the exciting part of dividend investing? That dividends can work harder than any of us can work possibly, because we're human. We only have 24 hours in the day. But when I buy a company like 3M, I have the entire organization of 3M working for me, and I don't even have to manage them. I have people at the organization, the CEO, board of directors, the VPs, the presidents, the directors, the senior managers. We have a whole team of managers there doing the management. And so that's the beauty of dividend investing. And that was my biggest takeaway today, is like, man, I'm moving too quickly here and I need to get more money working for me quicker. And so that's 3M. I want to move on really quickly to Cedar Fair. This is another one I purchased today. So I'm going to share some stats on the screen right now. This one is really exciting. I would say this is a top 15 stock for me, but within my top 15, maybe it is more of kind of I wouldn't call it junky, but a riskier play. It's riskier. And when I say junk, by the way, I'm not trying to make fun of any company. I'm just trying more using terminology of kind of like junk bond. Like there's bonds that are really safe. There's bonds that are a bit riskier. They're called junk bonds. And so certainly not a junk company. I love this, but it's a lot riskier, I would say, than something like a 3M. And it's a master limited partnership, real estate company, amusement park company. They had a blockbuster 2019 earnings release, and I was so excited to see that. And I think a lot of that good news, quite frankly, just got completely lost in this madness of the coronavirus and all of this press around it, that something good happening with a company like Cedar Fair, it just completely gets lost. But basically, I bought them at a almost 8% starting dividend yield. And being an MLP, there are more paperwork around it, a lot more K1s and such around tax time. But from a tax standpoint, I'd say it's actually more advantageous than your normal average qualified dividend common stock. And so that 8%, or nearly 8%, it's even better than it looks there. And so that's a really good starting point. And PE stuff here doesn't make a lot of sense. What I will do, actually right now, I'm going to do this really quickly, but I'm going to talk about some of their earnings and a quick cash flow analysis just to show you how I look at MLPs, how I look at Cedar Fair. So first thing I want to do is just pop on the screen some headlines from their recent earnings report. And what you see here is they had record results for 2019. Their attendance was up 8%. In-park per capita spending is up. Out-of-park revenues are up. They see significant increase in the sale of season passes for 2020. And they set a new long-term adjusted EBITDA target of $600 million by 2024. And by the way, their adjusted EBITDA for 2019 was at $504 million. So they expect it to go up nearly another $100 million by 2024, which is huge growth for these guys. And so Cedar Fair, honestly, is doing pretty well right now. And it's exciting to see that in face of competitors like Six Flags just crumbling. And I did a video on that recently. I'll share it in the description below. Check it out. I do wish everyone in Six Flags all the best. It's not for me, but I wish everyone much success who is over there as well. And that being said, I'll tell you a few things here. Six Flags mentioned minimum wage going up. That's going to affect Cedar Fair as well. This coronavirus, it's going to affect Cedar Fair. So Cedar Fair had a wonderful 2019. We'll see how 2020 goes. I don't think it's going to be all easy ahead, but I certainly believe that the distribution is safe. And I think that they're going to make it through these tumultuous times a lot better than Six Flags. And I'll tell you, I'm the kind of investor that likes to invest globally. I like companies that have assets all over the world and sell product all over the world. And I've done a lot of analysis on that here. I'll share in the description below. I would have thought Six Flags having that exposure in China would have been a good thing. It's so funny how sometimes your judgment's just wrong. Things happen in life. And the fact that Cedar Fair does not have China exposure, the fact that they're just focused on North America, it's been a blessing for Cedar Fair. It's been a really good thing for Cedar Fair. And so the lesson I took out of Cedar Fair recently is, hey, Ian, you thought one thing, you thought you should have all this global exposure, but you know what? Sometimes it's good to have companies just based here in good old USA territories as well, having some focus just in the USA or North America, that is, because they do have parks in Canada as well. But that North America focus, it actually did all right for them here. Now, I don't want to be insensitive here to the global health crisis that's happening now. My heart goes out to everyone affected, and prayers to those affected. And I hope we have a speedy recovery on that as well. But I just had to mention that because we're talking about something here where market's down because of this virus, but it's kind of an interesting situation because at the same time market's down and I'm buying stock. Why is it down? It's down because of this unfortunate, horrible virus that I hope quickly gets resolved for everyone. But I'll tell you honestly, is the market really down because of coronavirus? I don't think so. I think it's more down just because it's overvalued and this is an excuse for the market to go down. So that's another viewpoint I have. So I want to pop some more numbers on the screen as it pertains to Cedar Fair. I don't have a lot of time today, so I don't want to spend too much time on this, but this is my financial analysis of Cedar Fair. It shows the metrics from the last 5 years of operation. In 2019, I have an alternatives model as well. Nothing changes in these numbers in my alt, but it will on my next screenshot. But basically what you see here, revenue is growing steadily. Operating income, it's okay. There's been better years back in 2016, but it's generally growing. Some of the things I like seeing here is the adjusted EBITDA. Earnings before interest, taxes, depreciation, and amortization. It's in 2019 hit a record. And so record adjusted EBITDA. CapEx was also really high, by the way, because they made a lot of acquisitions. They have to improve the acquisitions with some CapEx up front. Attendance all-time highs, in-park per capita spending all-time highs. You just see here off the bat, looking at the numbers this way, market's telling me one thing. Market's tanking. Cedar Fair is tanking. But on the other hand, I don't look at that. I don't care about stock charts. I don't care about the media, this and that. What I'm doing when everyone's looking at all of that is I'm just sitting at home and I'm reading the financials. I'm updating my Excel models. And when I look at an Excel model like this, numbers are pretty good. Numbers are pretty good. And so I want to share another Excel model on the screen right now. I know I'm not going into these in too much depth, but what I do is I actually back into my own cash flow. And this is where the alt situation comes in. So MLPs, I'm just going to do a quick refresher. They have, EPS is just messed up because it has depreciation in it. Depreciation is not, well, it is real and it isn't real. Basically, at a company like Cedar Fair, you're able to depreciate your buildings, you're able to depreciate your roller coasters, you're able to depreciate assets. And so that depreciation, quote unquote, is their hotel over time is losing value. But is it really? Real estate here in the US, North America, generally rises in value over the long run. So depreciation, quite frankly, I need to take it out of the equation. It shouldn't be subtracted out. It shouldn't be subtracted out. But what's missing from EPS is CapEx. CapEx needs to get added in because capital expenditures are very real in the amusement park business. You have to upgrade roller coasters, you have to refurbish things, you have to refurbish hotels. And so whereas depreciation, it skews EPS, it makes it look lower than it should be. CapEx needs to be added in because CapEx is completely missing from EPS. And the EPS without CapEx would look better than it otherwise would. And so what I basically do in the numbers that you see on the screen right now, what I'm going to jump down to really is this cash flow proxy. I take the adjusted EBITDA, and basically what I do is I clean it up a bit. I make sure that CapEx is accounted for. I make sure that depreciation is not accounted for. I make sure that this provision for taxes is included, because there are some taxes here. There are taxes happening. Even though it's mostly a pass-through entity, there is a provision for taxes. I need to learn more, quite frankly, about how that works, because MLPs should be passing most taxes through, but there is a provision for taxes, and so that's not included in adjusted EBITDA. I need to include that, and so I make some adjustments here. Basically, what you see in the 2019 column is the cash flow is pretty darn bad. It's only 30 million. You look back at 2017, it was great. It was 204 million. And I have distributions here as well. And you see in 2017, 2015, they covered the distribution. 2016, they don't, but it's kind of close. 2018, they're off. They don't cover the distribution. 2019, they don't cover the distribution. This is why I do an alt scenario, though. The reason I do an alt scenario is the CapEx right now is wacky. It's way higher than it'll be because they made all these acquisitions recently and they're refurbishing them. And so what I did is I adjusted the CapEx down. I said in 2019, what if CapEx was more reflective of what it's been over the last 5 years? Also, provision for taxes was a bit higher in 2019. I think the reason for that is all these acquisitions. I think the taxes may pertain to the way these acquisitions are happening. I make the provision for taxes more reflective of what I've seen in the 5-year period. Basically, if I make my adjustments in my 2019 alt, and you see it above, the provision for taxes, I take it down from 42 million to 22 million. I take the depreciation, oh, that's flat. Okay, I'm bumping up the last screen again. So CapEx, you see this on the last screen. You see it in my alt. I take it down from 330 million to 175. The 175 million, I would say, is more reflective of what CapEx is really going to be in the long run. Anyways, my cash flow proxy in 2019, if I assume CapEx is kind of normal, if I assume provision for taxes is normal, what I get is 206.8 million. And the distributions are 211. And so basically what I show is in a normal year, they're covering the distributions with their cash flow. And so is the company a little bit ahead of themselves here? Yes. Is the company have a healthy, super healthy margin to be able to pay the distributions? No. Were they taking a strategic opportunity to make some acquisitions that they saw fit? Yes, and I think basically here it's I would say a riskier position in my portfolio. It goes back to what I just said in the beginning. There's two types of stocks right now, the premium ones that aren't tanking and the riskier ones that are. Cedar Fair falls a little bit into that riskier bucket, but based on this analysis here, I think a lot of people would completely miss the ball when they look at things like EPS or when they just look at the numbers the company provided. When I do my own analysis, I'm able to find that on an average year going forward, I believe that cash flow proxy will cover the distribution. And it gets more exciting because we know adjusted EBITDA, they envision it growing, and the top line numbers are all out of this world, and that bodes well for the future of this company. Now, there's a lot of other numbers in here. I don't have a lot of time. I just want to talk about cap rate. What cap rate is it's a way to evaluate real estate. And I work in the commercial real estate business, and I work in the self-storage industry and the multifamily housing apartment building industry. And so those types of properties here in California, they usually trade for, say, a 6 cap, somewhere in that range, sometimes lower, sometimes higher, maybe on average a 6 cap. What that means is you take your net operating income and you divide by 6% and you get the value of the asset. Well, I look at that for Cedar Fair here. I look at what I back into as their net operating income. That's what this pre-interest cash flow is above, because NOI doesn't include interest expense. And so that's why it bumps up to the 307 million, which, by the way, is at an all-time record. On a pre-interest expense basis, their NOI here, all-time record. And what's interesting is if I apply a 6 cap to that, like a building here in the Bay Area would go for, it values the company at about $5 billion. Now, keep in mind the market cap of this company right now is $2.5 billion. So that shows me that the company could double. It's probably not a 6 cap though. Let's say it's a 10 cap, which would be a really fair way to value this if it were at a 10 cap rate. That would put it at a $3 billion valuation. But again, the valuation right now is $2.5 billion. And so again, these are some of the things I see with Cedar Fair. You got some risk. You got great earnings. I think going forward, they're going to more or less cover the distribution. And I think it's trading undervalued based on their net operating income. And so good stuff there. Bought more. It'll probably go down more. I want to move it forward. I know a lot of numbers here, but I know a lot of you at home are working on improving your fundamental analysis skills. I am as well. I like doing these types of analyses because it betters my fundamental analysis. So that's why I wanted to show that stuff. So I'm going to flip back. I want to talk about a few more stocks. Those are the two I bought today. Let's talk about some stocks I did not buy today. Let's just look really quickly at Coca-Cola and Royal Dutch Shell. So Coca-Cola is down, you can see right here, 4% from the high. It's trading at a PE on a forward basis of 25. By the way, Royal Dutch Shell is down 30% from the recent high. It's trading at a PE of 9. And the starting yield is at 8.2%. So you, like again, I was saying before, you see a tale of two companies here. There are companies in the market right now that haven't, the premium companies like Coca-Cola, they haven't gone down. When those start tanking, that's when you know you really have a market correction. When Coca-Cola gets cut in half or goes down 30, 40%, you know you have a market correction. Right now, we're just seeing some stuff go on in certain sectors. Needless to say, I like Royal Dutch Shell here. I was thinking, should I buy more today? Should I go for it? Ian, should you do it? The reason I did not do it goes back to my lessons from before. I forget which lesson it is, but it was not getting ahead of myself. It's not borrowing from the emergency fund. I spent today what I could spend. I did it. I didn't have more. I could come up with more. I could borrow against savings. I didn't want to do it. And so I have to remind myself, Ian, it's a marathon. What I also remind myself is, Ian, your portfolio is pretty big now. If you bought more Royal Dutch Shell today, does it even really tip things one way or another? Not that much. And so it gives me peace of mind just to wait another few weeks, buy it then, even if it's a little higher. Better money management. And so that's how I look at it there. And so that's the tale of two stocks here with Coca-Cola, Royal Dutch Shell. I want to talk about StarBucks next. This is an interesting one. Frugal February is almost over. We were successful in saving $1,000. I recently did a video with my wife, which I will link to in the description below, about how we're saving money, and especially in Frugal February, our goal of $1,000. That money is going to go towards Starbucks. And Starbucks right now, if you look at these metrics, it's one of those premium stocks. Yeah, it's down a good 18% from the high, but it's still trading at a forward PE of 27. The starting yield is only 2%. It's got that awesome 20% compound annual growth rate, though, on the dividend. It's a premium growth-oriented dividend stock. And so the lesson here is, yeah, today I gravitated towards Cedar Fair. Yeah, today I gravitated towards 3M, which I would say goes more in the premium quality, but nothing like Starbucks in my opinion. Yeah, I recently bought BP. I recently bought Royal Dutch Shell. I recently bought Wells Fargo, which I'd all kind of lump in that category of stocks that aren't quite as premium. They're on the bottom tier of my 44 stock portfolio. I have to remind myself, Ian, even though it's not super cheap, you got to add to companies like Starbucks because those are the core of the portfolio and they help the portfolio weather any storm that could come its way over the next 50 years. And so that's just a lesson to myself, a reminder to myself. And I'm going to force myself to buy some Starbucks here, even though it's so different buying Starbucks here than it is buying Royal Dutch Shell or BP or Cedar Fair for that matter. All right, moving on to another one. Home Depot. These guys just had a great earnings report. It totally got lost in the news. Again, anything good coming out these days just totally gets lost in the sea of media. Quite frankly, some of the fear-mongering that goes out. I feel like the media needs to be a little bit more even-tempered and publicize some of these things, the financial press at least, as well, because they totally missed out on Home Depot. Home Depot had an amazing earnings. And what I want to share with you here is this stock, it comprises almost 2% of my portfolio. It's not a huge stock, but it's a good medium-sized position. Wells Fargo, it'll never be as big as Home Depot. And so again, I have to prioritize the core, and historically I have. I talk about some of these stocks in recent months, years that are not core, and it may seem like those are really big for me, but they're not. And that picture needs to be super clear because I am a huge advocate of having a strong core. Anyways, Home Depot, it's only down 4% from the high. It's just like Coca-Cola. Premium stuff's not on sale. Forward PE is a 22. Check this out. 5-year compound annual growth rate on that dividend. It's a stellar 20%. And what I want to share is I bought my first tranche of Home Depot back in 2014. I paid $74. I'm now up 216% on that tranche, and my yield on cost is over 8% now with their most recent dividend increase. And so this is what needs to get publicized, honestly. This is long-term dividend growth investing. This is why I love to invest for the long term. I don't worry about the short term. I'm always dollar cost averaging in, because when I buy stocks, honestly, Wells Fargo, quality company too. Royal Dutch Shell, quality company. Home Depot, ultra high quality company. When I buy anything, quite frankly, within my 44 stock portfolio, every different stock plays a different role. Over the long term, my belief is that they will all serve me well. My yield on cost will be good. My cash flow will be good. Just like Home Depot, the current yield is only 2.5%. But I'm yielding 8% because of when I bought. And that's the power of long-term investing, not getting caught up in the day-to-day. And I don't want to put anyone down, but not doing day trading or penny stocks or get rich quick, swing trading, this and that. I know different people have different strategies, and much respect to all the different types of investors. But for me, this is why I do dividend investing, because I can totally sleep well at night when the market is quote unquote in panic. I can think about other things. I can live my life. I can come back a decade from now and have experiences. Home Depot, it's even been less than a decade. This has only been since 2014, and look how well it's doing. And so power of long-term, power of just staying calm, staying the course. And I'll tell you, one thing I saw recently is people swaying from their strategy. I want to remind everyone in the community, if dividend investing resonates with you, be careful, because one of the things I've experienced in the past is dividend investing, it feels like it's moving slow. Oh, dividend investing, stock market's coming down now. Boy, am I ever going to get to where I need to go. This right here with Home Depot is living proof that it works. It'll happen. It just takes time. But the risk is, a lot of people, myself included, I've fallen in this trap in my early investing days, is I wanted the money quicker. Try some day trading, try some swing trading. It didn't work. It didn't work for me. And so what happens, and what I'm trying to plant the seed, is if you are a dividend investor, but you're just getting started, you haven't experienced a Home Depot-like situation yet, like I have, keep in mind that it will probably come sooner or later. And the biggest risk, in my opinion, one of the huge mistakes that people make, is they leave the dividend strategy. They say, hey, it's not working quick enough. I'm going to try something else to make quicker money. The quick money, and sometimes with the quicker money, you get these quick wins. You get a quick win, and then you think, oh, I must be an amazing day trader. I've got some quick wins. This is what happened to me, I'm telling you. But then the wins fizzle out. The money you start losing. And so, in my opinion, the single best investing strategy that has ever been invented, in my humble opinion, is dividend investing. This is why I do it during volatile times, during good times, during any time. I will always be buying quality stocks in my dividend portfolio. All right, everyone. Thank you for tuning in today. The best way you can thank me is to subscribe, comment, like. By the way, I sell merch as well. I'll link to that in the description below. I have some new styles coming out. I have the samples I've already ordered, so I'll be modeling those for you in some upcoming weeks on my Instagram, here on YouTube, so you can see what's coming your way. But if you want to order before you've even seen me wear it, I do have the new merch in the store for those of you that want to be ahead of the curve. It's really, really good merch. New designs. 2 of the designs actually inspired by members of the community on my Facebook group. And because of that, each of those members will be receiving a free t-shirt with their slogan that they suggested for the designs. And so mad respect to my friends, my 2 friends out there, Jeremy and Marty. Both of you guys, love you all. Thank you for suggesting those slogans, and you'll be getting your free shirts. Marty, please reach out to me, because I need to get your mailing address. I've had, I think, I don't understand, quite frankly, how to use Facebook. It's hard to explain, but there's so many bells and whistles in the thing these days that I'm having trouble messaging you and getting through to you. Guys send these messages, and I know you're trying to message me. And so let's just connect somewhere else, some other way. We'll connect with each other somewhere on social media, get it all sorted out. But Jeremy, your shirt's already on the way. And so I'll be modeling those again, though, for everyone in the next few weeks. But Thank you to everyone who supports the channel through merch, through subscriptions, through likes, comments below for the algorithm, all that good stuff. I love you all. In terms of full disclosure, I got to go through the stocks because there were a lot of them. I own the stocks mentioned today. I am long Cedar Fair, ticker symbol FUN, 3M, ticker symbol MMM, Coca-Cola, ticker symbol KO, Royal Dutch Shell, RDS-A, Starbucks, ticker symbol SBUX, Home Depot, ticker symbol HD, Wells Fargo, ticker symbol WFC, BP, ticker symbol BP, Altria, ticker symbol MO, although I don't think I talked about that one, but that's another one that's on my watch list. Honeywell, ticker symbol HON. I'm hoping that one is going down soon. And PepsiCo, ticker symbol PEP. I own all those stocks in my dividend stock portfolio. Also, as already mentioned, I'm not a licensed financial advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. Additional disclosures and disclaimers in the description below, as always. I love you guys. Stay calm. Enjoy life. I will see you all in the next video.